Hey, I'm Tatum Cave.
I'm Jayden Bishop.
I'm Anna Cacsio, and this is our presentation.
So in this presentation, we will be comparing Ford and General Motors and their valuations. We found General Motors to be an undervalued company and Ford to be an overvalued company. General Motors is home to many car brands like Buick, GMC, and Chevrolet. Both of these companies are in the automobile sector, and they both engage in the manufacturing and distributing of automobiles and vehicle parts, among other things. Valuation number 1, for General Motors, we chose to do the free cash flow model. All this data is from May 4th. The formula to get the free cash flow model is net income plus non-cash charges plus the change in working capital. Non-cash charges are depreciation plus amortization, and then the change in working capital is current assets minus current liabilities. The net income is $6.73 billion plus the non-cash charges of $14.06 billion plus the change in working capital, which is $74.99 billion minus $84.91 billion, and that equals $10.87 billion.
Then for the second valuation, we looked at the price to earnings ratio. Just a precursor, price to earnings is literally just the price divided by earnings per share. As of May 4th, from MarketWatch, the General Motors price of $20.69 divided by 457 ended up being 453. And 453 is, you'll see later, it ended up being the positive PE ratio that we found. So that means that it is expected growth rather than decline. And we'll explore that later on once we look at the other ratio.
Okay, in the first valuation for Ford, we did free cash flow model. So our net income was $47 million plus our non-cash charges of $8.49 billion plus our change in capital and working capital of $114.05 billion minus $98.13 billion, which equals $24.46 billion. And all this data was from MarketWatch, and it was also on May 4th.
So then we looked at the PE ratio of Ford. Again, same constants of May 4th, MarketWatch. You can see that it is 487 divided by negative 0.76. That ended up being negative 6.4, which shows that it is an undervalued company. The future is looking like a decline for Ford.
As far as the two companies we evaluated outperforming or underperforming the S&P 500 in the next 5 to 10 years, if you look at the graph that I put on the PowerPoint, Ford and General Motors had a decreasing trend the previous 5 years. General Motors had a peak in November of 2015, and they actually outperformed the S&P 500 that month. But since July of 2019, they've continued to decrease. As far as the coronavirus, it's had a big impact on Ford and General Motors, along with every other company. But in the next 5 to 10 years, I think that both companies will underperform the S&P 500, especially with models like Tesla being way more innovative and stuff. Ford and General Motors is going to continue to decrease. The automobile industry, it's been on a decreasing trend since 2018. If you look at the chart on the PowerPoint, you'll see that it's starting to increase a little as it took a really big impact from the pandemic, but it's consistently underperformed the S&P 500 since 2015. If the valuations and previous year numbers continue a trend, the automobile industry will continue to underperform the S&P 500.
So finally, we'll look at comparing the two. As you've heard, the numbers have been decreasing over the course of several years, and it is not solely due to the pandemic, but you see that gathering this data in the middle of the pandemic obviously showed bigger decrease. So on the bright side of that, in the near future, once the economy starts to recover, they're going to start showing some positive trends relative to the time, but both are going to show a general decrease in their trends. As far as looking at each one to choose over investing, General Motors is going to be the better choice due to them having a much different PE ratio than Ford, being positive. Ford has a lower outlook because it is undervalued, and General Motors is predicted to grow a little better than Ford over the next few years.